Hey, good morning, everybody. Hope your December is off to a good start. Maybe you already started or finished your Christmas shopping. Actually, we probably have. We got a couple little gifts left to get for some family members, but we're at the point now with the kids pretty much grown, and Michelle and I haven't been married for 24 years. It's not a whole lot of spontaneity. Everybody just says what they want. And I mean, it's a point, like I bought my Christmas gifts, Michelle bought hers. And so it's not even, we're not even buying each other's gifts anymore. It's more like we just get what we need. So I'm getting floor mats for my car and a little thing to hold my cell phone. And she's getting some new knives for the kitchen. And it's just kind of interesting. And then the girls, they just kind of pick out their thing, and we purchase it on Amazon, but no big surprises anymore for Christmas for the most part. And I also want to say that you can probably see up here, this actually says joy, but because of the camera angle, it's backwards. So if you're looking at that, go, what's YOL? What does that mean? It's our holiday decorations are up in the office. So that's what that is. So you don't have to sit and worry about that too much. So today I put together a presentation, had a conversation this week with a client, and we were talking about sort of the end game for government debt, like what's going to happen here, what's the path. So I try to put some basic stuff together to kind of give you an idea of really where we stand with government debt. Last presentation, I said I would talk about sort of what I see in 2024. I'm going to do that for the next Coffee with Kirk, because that will be right before the new year starts. So I'll go through all the economic slides and everything like that. This time I'm going to try to explain a little bit the government debt and why it's a problem. I'm not going to go too deep, but it is a little meatier than most presentations. But I think it's interesting and it's pretty important, obviously. So it was a good topic and kind of timely. And the reason it's timely is we're starting to see some cracks form in government auctions. So, the government takes their bonds when they need to raise money, they go take bonds to auction. And basically it's just like any other auction where you're, trying to find buyers for your debt. And we're starting to see some issues with it. And that could expand even further. So we'll dig in a little bit. I'll try to just make it really simple. But it is, you have to have a little understanding of Fed operations, but we'll talk about all that stuff. So as usual, what I'll do is I'll jump into some slides here, and we'll be off and running. So again, we'll talk about government debt, and I'm going to start off by talking about the reverse repo market. So I'm sure that sounds daunting or boring, but that's what we'll get into, and I'll explain kind of why that's important. We'll start right off with it. So you have to remember that you probably may have heard how the Federal Reserve is the lender of last resort. So during the period of our existence as the United States, when we did not have a central bank, what would happen is if banks needed some short-term financing, they needed some cash, they would go out to other banks. So some banks that had lots of cash but didn't have a lot of like hard assets like treasuries or mortgage bonds or any kind of collateral, a bank that needed cash would go to them and give them some of their collateral, and then they would get fresh cash. So the banks worked together. Now, sometimes what would happen when you'd have bank runs, essentially what that would be a point where none of the banks would loan to each other, but yet many banks needed cash. So, just think back to It's a Wonderful Life and, the bank run with George Bailey. They're all standing there wanting their money. Well, in that instance, George Bailey was able to keep $2 in his vault, but a lot of times the request for cash is greater than what the banks have on hand. So they need cash. They needed it. And you get to the point where the banking system would lock up because nobody trusted that any other bank is solvent. If you're coming to me saying, hey, I need cash, I'm going to start to worry like there could be some big issues here. So that was the whole issue to start the Federal Reserve. That's not the official reasons why they started it. They started it to say that they're trying to keep, inflation in check and keep a stable banking system. But really, it was a way for the banks not to take the risk. It was a way for them to offset it to us, the consumers. That's essentially what the Federal Reserve is. And, without going too far down the Federal Reserve rabbit hole, they really haven't been able to do what their objectives were. So, keeping stable prices in a stable banking system. Well, we had the Great Depression when the Fed was in existence, and then we had 2008. So really, as bad as the bank runs or the wildcat banking from the 1800s and really early 1900s. So it wasn't really an improvement, but it did reduce the risk for the banks. So I know I'm going in here pretty deep, but so the way it works now is rather than banks having to go to other banks to get cash, they go to the Federal Reserve. And they do what's called a repurchase agreement, or now it's for short, they call it the repo market. So it's a repurchase agreement. So for a bank that needs cash, what they would basically do is the bank would go to the Federal Reserve and give them some treasuries, give them government bonds or government securities as collateral. And then what would happen is the Federal Reserve would hand that bank cash. And it would be a loan. And now these loans are very short term. We're talking, 1-2 days. They're not long-term loans here. So the commercial banks would get the loan. And then, in a couple of days, a day or 2 days, they'd go back, give the cash to the Federal Reserve plus the interest that's being charged. And then the Federal Reserve would give them back their collateral, which is government treasuries. That's the repo market, the repurchase agreement market. And this is typically how you see the Fed operating. But there's also another way where the Fed will operate, and it's called the reverse repurchase agreement market or the reverse repo market. So this is a case where rather than the commercial banks needing cash, this is where they've got too much cash and they don't know where to park it. Now, there's a lot of restrictions on where banks can put their cash. Now, as you know, going back to that George Bailey example, when everybody was asking for their money, George Bailey saying, well, your money's not here, it's in Joe's house. And Mary's money's not here, it's in Larry's business. So, banks put money in all kinds of different vehicles. So they have some mortgage loans, they have auto loans, they'll have commercial property loans, they'll have business loans, for working capital for businesses. They'll have treasuries. They have all these different assets that they can invest in. But the Federal Reserve, the FDIC, and for credit unions, the NCUA, all have limits on how much you can invest, how much a bank can take their cash and put it into different entities. So there's a limit to what they can do. So there's sometimes when maybe they've already got the maximum amount of mortgage loans and auto loans and commercial loans that they can do, and they've got too much cash. So what do they do then? They don't want to just sit there with the cash itself. They want to earn some money on that cash because they're paying out interest to the person who gave them the cash. So in this case, it's just literally the reverse of what I just showed you with the repurchase agreement market. This is where the commercial banks take cash to the Federal Reserve, and then the Federal Reserve would hand them treasury, bills, bonds, or notes. At that point, again, short-term loans. So the bank comes back, gives the Federal Reserve the government securities, and then the Federal Reserve gives back the cash to the commercial bank plus interest that the bank has earned for loaning that money to the Federal Reserve. So, like I said, typically the focus is on the repo market, not the reverse repo market. But the thing is, right now, the traditional repurchase agreement market is really non-existent. So banks aren't really in a need for cash right now. They've got plenty of cash. Without getting into the nuances of this, you look at the zeros, and basically what it's saying is there is no repo market right now. There's nothing that banks are coming to the Federal Reserve, giving them government securities, and then getting the cash. That's not happening. But what is happening is once we had the stimulus from COVID, and again, you can see this sharp rise up in March of 2020, enormous amount of money printing by the Federal Reserve. Well, all that money got out to the consumers through the government, all the different stimulus packages, the $1,200 payments per person, the extra unemployment insurance, the PPP loans, all that stuff that the government handed out. Well, all of a sudden, there were a lot of people that were flush with cash. And what did they do? Well, they put that cash in the bank. So we now have a situation where the commercial banks had just massive, massive amounts of cash on their books. And so much cash that they really couldn't lend it out fast enough. Like if you all of a sudden get 20 or 30% of your asset base in cash overnight, you can't lend that out that fast. There's no way the banks can actually go out and find auto loans and mortgage loans and commercial loans and everything like that. They can't. You have to underwrite these people. You have to do due diligence. So if you have this massive, massive influx of cash, well, you can't deploy it all right away. So that's where the reverse repo market comes in, because you can go out to the Federal Reserve and give them the cash, you get a security, and you're going to get interest on your cash. So you can see here, basically starting in early 2021, once the banks got all this money, they didn't know where to park it. They couldn't loan it out fast enough. So they put it in the reverse repo market. And you can see it just exploded up, by over $2 trillion in less than, about a year and a half. So by the end of 2022, there was about $2.3 trillion in the reverse repo. And you can see before COVID hit, and this only goes back to January 2020, but for the most part, the reverse repo market was not being utilized because banks weren't flush with cash. So all of a sudden we have a massive amount of money in this reverse repo market. And the reverse repo market was paying 5.3% interest for the bank. So the banks got all this cash and they looked at it and said, we can just park this here, have essentially zero risk, and get a 5.3% return. So a lot of banks weren't even looking to give out car loans or mortgages or commercial loans or anything, because they could basically get this kind of rate, without taking any kind of risk. Not a bad deal. Now, this is where it starts to get interesting. So why did I explain the repo market and reverse repo market? And what's that got to do with the government debt and talking about the future of that? Well, so as you are probably all aware, I mean, we are going through, we've got a massive amount of government debt. Right now, it's pushing $34 trillion of public debt. So the government, like I said, they have to do an auction. They go out and anytime they're selling bonds, it's an open auction and they need buyers. Well, what's typically happening right now is Treasury bills, T-bills, are yielding about 5.5%. So if you're a bank, you're sitting there, maybe you've got money in the reverse repo market that's earning 5.3 and you're kind of happy, but then all of a sudden you see T-bills come out and they're yielding 5.5. And T-bills are just as safe as the Federal Reserve assets. T-bills are the most liquid market in the world. So you have ample liquidity and you got just as good a guarantee, so you don't have any risk, but you can get an extra 0.2% in interest on your loan. So what's happening is the reverse repo market is in fact one of the biggest buyers of government debt, specifically T-bills. They want that short-term money and a guarantee. So you can see the Treasury bills basically starting in COVID exploded up the amount that they were issuing because the government needed short-term cash in 2020. And it started to come back down after COVID we got through that. But it's exploding back up. The Treasury bill market is exploding back up to basically $5.5 trillion. Now, in normal situations, when the government would go out to issue bonds, and remember, there's a lot of different, we have Treasury bills, which have maturities of 1 year or less. So bills are very short term. And then you have Treasury notes, which are between 1 year and 5 years in duration or maturities. And then beyond 5 years, we have bonds. We have Treasury bonds, and those go out to 30 years. So a typical balance sheet or a typical process for the Treasury Department is they issue about 20% in Treasury bills and 80% in longer dated bonds. So about 20% of the government debt at any given time is pretty short term, a year or less. And usually that's just to fund very short term expenses for the government. But the vast majority of the debt is longer dated bonds that they're paying for from anywhere from 1 year to 30 years. Well, right now, the amount of issuance in government debt is 65% T-bills and 35% longer dated bonds. Now, there's a couple of different reasons for that. The first one is that, rates have gone up substantially since 2022. And the federal or the Treasury Department probably doesn't want to issue a lot of 30-year bonds when they're, close to 5%. Thinking that we're stuck with that 5% for the next 30 years. So they're using T-bills to try to avoid paying higher interest rates over the longer term, all predicated on the assumption that rates will eventually come down. Once the Federal Reserve has inflation under control, they expect rates to come down. So maybe once rates come down, they'll go back to longer dated bonds, but they're not doing that right now. So we have a massive amount that's going to T-bills. And again, as I mentioned, the T-bill rate is 5.5%. So as I alluded to already, what's happening in the reverse repo market is that money is running out fast. So we're gone from, basically $2.3 trillion, and now it's down to about $870 billion. All of this money, I can't say all the money, but most of this money is going to T-bills. So they're going out to T-bills to get a little bit higher interest rate. Now, some of the money may come back to the bank because they might loan it out, something like that. But the vast majority of this money is just basically going from the Federal Reserve reverse repo market over to T-bills. So essentially, the banks have been one of the biggest purchasers utilizing the reverse repo market of government debt. But you can see we don't have a whole lot of time left here for this reverse repo. It's going to be drained here in probably January, maybe February of next year. And this is where it starts to get a little sticky for the government, because over the next 4 months, the federal government, the Treasury Department, is going to issue $1.5 trillion in new debt. That's so by the end of March, they have to issue $1.5 trillion in new debt. Now, this is debt due to not bringing enough tax revenues, but it's also just refinancing the debt that we already have that exists. So this reverse repo, one of the biggest buyers of T-bills, is going to be drained in 2024. So at that point, the Treasury Department is going to need to have other buyers at their auctions, because the banks just aren't going to have the cash. It's going to be gone. And we're starting to see some problems in longer dated Treasury auctions. So we mentioned just previously about 65% of the current Treasury debt is being issued as T-bills, with the rest being longer dated bonds. But even when the government goes out and tries to do some longer dated auctions, it's not working out too well. So just a couple of days ago, November 28th, the government tried to do a 7-year note. That's what they were auctioning. And they just didn't have as many buyers. Now, it wasn't what we call a failed auction. They did find buyers, but they had to raise their rate in order to entice the buyer to actually purchase the Treasury bonds. So we saw, that's not a good thing when you go out there and the Treasury Department says, well, we're issuing these 7-year notes at 4.55%, and then they can't find enough buyers at that rate, and they have to come up to 4.6, 4.7, 4.8, just like a normal auction. So that's showing some weakness in the demand for longer dated treasuries. And with the reverse repo market emptying out, it's going to be even a bigger problem. So it was a challenging auction, but it did work. But just back on November 9th, we actually had what they call a failed auction. This was for 30-year bonds, 30-year Treasury bonds. So it was a failed auction. And what does that mean? What is a failed auction? Well, just as you can tell, failed auction just means they didn't find enough buyers for their debt. Now, the way that the auctions work is there's 3 different buyers. Indirect bidders here, where you see this indirect bidder, that is actually foreign buyers. So that's going to be foreign governments, or foreign hedge funds, foreign pension funds, things like that come in and buy treasuries. And you can see the vast majority of our treasuries are purchased by foreign buyers. Direct bidders are in the United States. So this is your hedge funds, your mutual fund companies, your pension funds, and individuals who buy treasuries direct from the government. And then what's a primary dealer? Well, primary dealers are actually sort of what they call market makers. So they're the ones that sort of facilitate the auction. So they're on the hook for these bonds. So they take all the government bonds, and then they are the ones that facilitate the auction. So they're the ones that are doing the deals with the direct bidders and the indirect bidders. The worst thing that you can have, and why it becomes what they call a failed auction, is when the primary dealer cannot find enough buyers for the debt. And guess what? They're stuck with it. So at that point, the primary dealers, they're stuck with this debt. Now, it's not a horrible thing because eventually they go back out. These are big brokerage houses, big players, and they eventually sell to their retail clients or institutional clients. And so it's not a big deal to have some of that debt. And in fact, a lot of times a primary dealer will purchase the debt because they have clients themselves that will eventually want the debt. But that's usually, you can see 9-10% is a normal amount that they would keep. The rest should go out to the other bidders. But this looks at looks at 3 30-year auctions. So January of 23, October, and then just less than a month later, November. So you can kind of see there's some trends here. The first trend is the very bottom line where it says total competitive. So you can see the amount of debt that we're issuing is going up extremely fast. So, going from 17 trillion in January to almost 24 trillion in November. So we're issuing a lot more debt. And then the other thing to notice is the percentage that's being sold to international buyers, the indirect bidders. That's dropping pretty fast. So you're starting to see China and Japan specifically, but other foreign buyers start to, not come in and purchase as much in the treasury market. So it could be a variety of reasons. And I've, danced with that topic a little bit previously. For China, their economy is struggling, so they don't have as much cash flow that they could put in there even if they wanted to, and they're starting to spend some of their treasury money on internal issues. Japan's having issues as well. They're at a point where we're probably heading, where they have to prop up their bond market and try to protect their currency at the same time, which is forcing them to sell treasuries. So you're starting to see some demand drop. The other reason could just be the fact that we are increasing our debt so fast that foreign buyers are starting to question if they should put money here at the United States. And it's also happened a little bit with the direct bidders, the internal United States buyers. Not as much. It's not as big of a decline. A little over 1% decline in the amount of direct bidders. That's not, I don't think that's statistically significant, but it definitely is for the indirect bidders. But so what ended up happening was the primary dealers were stuck with a lot more inventory than what they ever would want. Almost a quarter of the auction ended up on the primary dealers' books. They were stuck with that. So that's kind of what you call a failed auction. So we're starting to see some issues with the Treasury Department and the amount of debt we have. Now, this is a little bit dated. I'm sure you've seen the U.S. debt clock, and you've seen the one in Times Square that's always going up, showing it by the second. This shows, if you start in the far left, it says U.S. national debt. 30 trillion. It's actually closer to 34. So like I said, this is a little bit dated. I think it's only from really basically the end of last year. So you can kind of see how things are flying up. But then if you come over to the sort of the green area, the right side, and you see U.S. federal tax revenue. So we have about $4.4 trillion in tax revenues. And that's from, all the different sources of revenue that the government gets: income tax, corporate tax, your Social Security, Medicare payments, the amount we collect at the ports the tariffs, everything like that. All of that basically amounts to about 4.4 trillion. And as we discussed previously, one of the reasons I kind of think we're heading into recession is the amount of income tax coming in is down 9% from last year. So income tax is dropping, which usually means that there's less economic activity. So we have about 4.4 trillion in income coming in. Overall, we have close to 34 trillion of total debt. And this chart is a little bit dated too. Right now, our gross domestic product, or GDP, is about 27 trillion. So that's the figure of all the goods and services produced by our economy. But we have 33 trillion in debt, almost 34. Now this chart's saying, this was, I think, this is a moving average, and it's saying your 5-year moving average is debt to income of 120%. Now, if you take the current debt to income, we're really at about 130%. And this has a little note here. You see Reinhardt and Rogoff, kind of the impact point. And this was a study that was done a while ago by two economists, Reinhardt and Rogoff. And the book's called This Time is Different. And basically they're saying once a government gets past 95% debt to GDP, you start to see some issues. You start to see problems. So basically what this chart is showing is we're well past that point. We're way up at about 130% debt to GDP right now. Because when you think about it, the revenues that the government brings in is all predicated on the GDP. So the more goods and services that you and I produce, the more the government gets. So if you're able to produce twice as much in goods and services as you did the year before, the government's going to get twice as much tax revenue. So the fact that their debt is going way past essentially what we can produce for them, it causes a problem. So, just kind of looking at the bottom line here, we have, all right, 4.4 trillion in revenue for the government. Now, if you look at our budget, we basically, just in entitlements, we have about 3.7 billion, Social Security, Medicare, Medicaid, all the things that we have to do, the pensions, all that kind of stuff, government pensions, guaranteed VA payments, military pensions, all that jazz is about 3.7 billion. That's just entitlements. And then you throw on top of that, last year, we had 800 billion in defense spending. So right off the top, just with entitlements and defense spending, we've got about 4.5 trillion in expenses, which is greater than our 4.4 trillion in revenues. Now, that doesn't include all the government agencies. So all the other three-lettered agencies that are out there, this doesn't even include their spending. So that shows you we have an even bigger shortfall. And then the other big line item is the interest on the debt. We have to pay interest on the debt. And the CBO, Congressional Budget Office, was saying that, basically for last year, we had about 400 billion in interest. And remember, last year, interest rates were just starting to spike in 2022. So it wasn't even a full year of the rates being as high as they are now. So clearly that's going to be more. So you can see we've got a serious issue here, and it's really going to get worse. This chart shows you a few of the Western economies, their debt based on maturities. So you look at this, when you see the dark blue, that's debt that's maturing between 0 and 2 years. The I don't know, brown or whatever that is, it's 2 to 5 years. Kind of the light blue, I guess ladies who know more about colors, guys call it light blue, dark blue, medium blue. I guess it would be cyan. That is 5 to 10 years. Green is 10 to 30 years. And then if you have purple, that would be 30 plus years. You can see now, you look at Austria, France, Germany, UK, kind of spread out, sort of diversified. But you look at the United States, we've got 45% of our debt maturing within 2 years. And this was basically from January of 2023 for us. Okay. So as of January 2023, we were going to have basically 45% of our total debt, the $34 trillion, 45% that's maturing in the next 2 years. And we don't have any debt that's 30 years or older. So, when you take within the next 5 years, you're looking at about 70% of our debt's going to roll over. And we're now at much higher rates than we were before. So because we had so much short-term debt, and right now that's yielding those T-bills were short-term 2 years, they're close to 5.5%. That's a huge expense that's coming up. We're going to be paying more and more and more on the debt. Just as of 2021, T-bills were yielding, less than 1%. So what the Treasury Department did is they put a lot of money in short-term debt because it was so cheap. So T-bills were under 1%, and the 10-year, say the government 10-year, was at 2.5%. So yeah, I guess it made more sense to pay less, less than 1% compared to 2.5%. But now that's sort of biting us in the tail end because we're having trouble getting buyers for our debt at longer maturities. And so we're basically rolling over debt at 5.5%. So we're going to have a massive amount of interest expense that's going to be coming in here over the next few years. And so just doing sort of back of napkin calculation, and I'm only assuming here 30 trillion of debt, not the full 34, but 50% of the debt, roughly 15 trillion, plus the deficits that we're going to have of basically 2 trillion next year. If we're financing that at short term, which it looks like, and I'll even say we'll just do it at 5%, not 5.5%, that's about 475 billion in debt next year. So for 2022, our total debt load was 400 billion. Now it's going to be 475 billion just on the short term. We still have 50% of the remaining debt that's out there. So another 15 trillion. And the average rate on that is about 3%. So anything that's not the short-term T-bills, when you look at the government debt load, it's about 3%. It's 2.9% is what they're paying on the remaining debt. So that's another 400 billion. So we're looking at a minimum of 875 billion of interest in 2024. Now, I've actually seen calculations, it's probably going to be closer to $1 trillion. But at 875 billion, it's now going to be the largest expense that we're going to have. It's going to eclipse the 800 billion that we give to defense spending. So when you factor that in, that interest is going to be our largest line item on our budget starting next year. That's a little bit scary. And the thing is that the GDP ratio that we talked about, once you get past 95%, it starts to get to be problematic. And this is by the Congressional Budget Office. So, the CBO is always, they're pretty good, but they're always kind of underreporting when you finally get to see the end result. But it's very difficult for them to project. Essentially, they have to project what are the three stooges or the Keystone Cops in Congress going to do. Awfully difficult to tell. But you can kind of see that they're projecting here, by 2030 will easily be well over 100% debt to GDP. But as we progress through the decades, they're saying that by 2050 will be 180% debt to GDP. Now, that's not going to happen. We'll never be able to get to that point. Something's going to break before that. There's just no way. If you go back to the 1940s, even at the peak of World War II, we barely cracked above 100% debt to GDP. And then once the war ended, the government paid that down, that debt. So clearly some problems here. And then the other thing is the Congressional Budget Office is sort of projecting annual deficits. You can kind of see here the big spike down was COVID, obviously, and then they're showing the last up through 2032 of what's going to be, essentially happening here. So we're talking about easily 5% of a deficit compared to the revenues we have, but that's based on, I think, probably optimistic projections by CBO. Like I said, they're usually more optimistic. They're pretty realistic based on today's data, but what always happens is Congress ends up spending more money than CBO uses in their projections. So we've kind of got a situation coming here, and what's going to happen is we're heading into sort of a debt spiral, honestly. So this is where the debt and the interest continues to expand, and the government just starts not being able to afford buyers. So at that point, if you can't find buyers, you've got one of two choices. The first choice is to let the market dictate an interest rate, which means that the government interest rate would have to come up in order to attract buyers. So interest comes up to the point where you find enough buyers at the auctions to buy the debt. But if that happens, you start to see your debt and interest expense continue to expand even faster and faster and faster. The other option is that the Federal Reserve will come in and they'll essentially print the money and buy the Treasury bills, bonds, notes on their own. And when the Federal Reserve comes in, they can basically pick whatever interest rate they want because they're just printing the money. Now, we've seen this happen in Japan. Japan has put a limit on what the interest rate could be for the Japanese 10-year notes, 10-year bonds. So at one point, the Japanese central bank said, we're not going to let the bond interest yields go above 0.1%. Anytime they did an auction in Japan and the auction was going to have to raise rates above that, their Federal Reserve, their central bank, would step in and buy the bonds at 0.1%. And they've done that forever. But they're now getting to a point, and I've alluded to this year, that they're starting to let the interest rates go up a little bit slowly because of all the money printing they're having. They're actually starting to see inflation. So when you have this situation that a Federal Reserve or central bank starts to print the money to buy these bonds, by printing more money, that's naturally inflationary. So you end up getting to a point where you have high inflation, or you're going to have to let the bond market sort of suffer and let interest rates go up, which then makes it worse because then the Treasury Department has to issue bonds at higher interest rates. The interest expense becomes even bigger and bigger, and you have more and more problems. So they have to take out more and more debt, and then they have more and more interest rates, or they have more and more rates going up. The rate continues to go up because they're issuing so much more debt. It's a spiral. So they're issuing debt. They have to do it at a higher interest rate. It causes more interest expense, which means they have to do more debt, which causes interest rates to go up, which means they have more interest expense, which means they have more debt that they have to do. So you can see other things spiral. So, but the problem is if the Federal Reserve comes in and buys this debt and pays 1% or whatever they dictate, that 2%, whatever they decide to do, well, but they're printing money, which means that there's going to be inflation. So if inflation continues to go up, you're going to have an angry populace. You're going to have angry consumers, angry voters. So then if they say, well, okay, we'll raise interest rates in order to stem inflation, well, that gets us back to now we have the debt problem, the interest expenses going up. So at the end of the day, and Japan's starting to face this now, either you save the bond market or you save the currency. You can't do both. There's no way to do that. You have to make a choice. And the choice is, are they going to either allow massive inflation for us, or what they're going to do is kind of let the bond market fall apart. And the other thing that we've talked about before, and another reason why I kind of feel like we're certainly heading into a recession, is when interest rates go up, it ends up manifesting itself in the economy. So I mentioned previously that really the whole United States debt complex is based on the US 10-year rate, mortgages, auto loans, commercial loans, everything like that. So if that continues to go up and people have to pay more and more in interest expense, what's going to slow economic activity because people can't do it? Your credit cards are tied to it. Everything's tied to that. So you end up with a situation where you just have less economic activity when you let that happen. But what's the other option is, they keep interest rates low, and then you have inflation. So we're kind of stuck in this point. And I can't tell you exactly when that's going to happen, where we start to really see a debt spiral. I don't think it's going to be, next year or anything like that. But we're getting to that point where if we don't start to get something under control here, it is going to get out of hand. So my thought is it's always been that at the end of the day, the Federal Reserve is going to, protect the bond market and let the inflation rate go up, because they're going to have to. So, the other option is we let interest rates climb drastically, and then you have less economic activity, which here again affects the government debt load because they're all predicated on the GDP. All tax revenues are. So they get tax revenues based on how we do with the GDP. So you can kind of see, just that spiral that could happen here, with the debt. So I know this isn't a whole lot of fun to hear all this stuff, but this is kind of the reality, and this is what we're sort of seeing on the ground right now. At least right now, things aren't breaking, and I think once we see things start to break a little bit, that's when the Federal Reserve will step in. And right now, the markets, the stock and bond markets, are both thinking that the Federal Reserve is going to start to lower rates, but they have been very clear, and Chairman Powell of the Federal Reserve came out even yesterday. It was yesterday or the day before, and said, no, we're holding rates where they're at. We still have work to do on inflation. We'll see what happens, but we're at a point where we absolutely need to get the government debt under control, because once it starts to spiral, there's nothing that can stop it at that point. So yeah, there's your holiday cheer for the day. But it was a good question. We had a good conversation with the client. He's like, you really need to get this information out there, because we were talking about, should you invest in long-dated bonds? What's the potential there? And how could you invest if the bond market goes awry? And there is a holding out there that it's a very volatile holding, but it does go against the interest rates. The ticker symbol is TBT, if you want to look it up. But that basically goes against if the Treasury interest rates are going up, then that holding actually makes money. So as the Treasury struggle, that thing does well, but it's extremely volatile, and it's using it's using futures contracts in it. So a lot of it, it's quite volatile, and it doesn't perfectly track what's going. It's not a perfect correlation as the inverse of the treasury market because of the futures contracts, but that is something that you could look at. So it's going to be pretty important to watch that. Right now, ironically, the bond market interest rates are starting to come down a little bit, and a lot of people think, well, it's a soft landing, and the Fed's going to start lowering rates. They think that's why it's happening. But what I think it's a bigger tell of the bond market could be seeing a slowdown in the economy. That's what they're seeing. And when you have a slowdown, that's deflationary and interest rates come down. And I think that's kind of backed up if you look at the price of oil, which is the key ingredient to the economy. Right now, it's not solar, it's not wind or anything like that. So the key input to the economy is coming down too. So when both of those things are coming down like they are, typically it kind of says that we're having an economic slowdown. If interest rates were coming down because things are really good, the price of oil will be going up because we need more oil if we're going to have more economic output. So we'll see. And like I said, the next presentation I do, I'll kind of get more into sort of the outlook for 24, specifically a lot of the economic indicators I've been looking at and I've been talking about for a while. So we'll talk about that stuff. But today I just thought I had a good conversation with the client, and he's like, you got to get this out to the group. It'd be a good topic because it is something that down the road, and it could be 10, 15 years, could be 20. I don't know how long it takes for the spiral to start, but if things aren't fixed a little bit here, it's going to happen because it's just mathematics. It's not a political thing. It's not a Democrat, Republican thing. It's just math. So anyway, we'll be back in 2 weeks, and I'll kind of do a bigger discussion of the economy and what I see then. Until then, hey, get out there, do your Christmas shopping, enjoy time with family, the important stuff, and I will talk to you all later. I don't see any questions, so we'll take off. Have a great weekend, everybody.